So, yet another bank has collapsed, and this time it could have serious ramifications for the tech industry. The demise of Silicon Valley Bank, combined with the failure of Signature Bank just 2 days later, has had a serious knock-on effect, with investors questioning the stability of other banking institutions and wondering if their money is ever truly safe. While the US government has moved swiftly to allay these fears, and it doesn't seem like the consequences will be anywhere near as bad as the 2008 financial crisis, the fact that a bank with over $200 billion in total assets can collapse so suddenly is a great concern. Here's everything you need to know about the spectacular failure of Silicon Valley Bank and what it could mean for you. Founded in 1983, Silicon Valley Bank, or SVB for short, established itself as a prominent lender in the Bay Area, serving local industries like the wine industry and, most notably, the technology sector. Its client base included significant startups such as Beyond Meat, Cisco, Vox Media, and DocuSign. Over the last 2 decades, the bank expanded rapidly, opening its first international branches in 2004 and becoming the 16th largest bank in the United States, which it did by leveraging the tech industry's growth. SVB primarily generated revenue from traditional banking services like loans, asset management, and underwriting tech IPOs in collaboration with venture capital firms. With its willingness to take on higher risk clients, SVB was a go-to financing source for tech companies, supporting them when other banks shied away. As a result, Silicon Valley Bank provided financing for around 50% of all US venture-backed technology and healthcare firms. Of course, the global events of 2020 triggered a surge in demand for digital services and electronics, driving a hot market for technology. SVB played a vital role during this time by helping tech firms manage their cash for business expenses such as payroll. Like any bank, SVB invested much of these deposits in various ways. As recently as the start of 2023, SVB was recognized in Forbes' list of best banks. So, what went wrong? There were several factors that contributed to the collapse of Silicon Valley Bank, but the main two were a lack of diversification and an almighty bank run. SVB invested a significant portion of its deposits in long-term US treasuries and agency mortgage-backed securities, which are susceptible to a decline in value when interest rates rise. Unfortunately, when the Federal Reserve increased interest rates in 2022 to combat inflation, SVB's bond portfolio began to falter. However, the bank would still have been able to recover its capital if they had held on to those bonds until maturity. In 2021 though, SVB made a shift towards long-term securities to generate higher yields. Yet, they failed to safeguard their liabilities with short-term investments that could be quickly liquidated. Consequently, when economic factors impacted the tech industry and venture capital became scarce, many of the bank's customers withdrew their funds. Unfortunately, SVB did not have enough cash reserves to honour these withdrawals, as their funds were tied up in long-term investments. In an attempt to rectify the situation, the bank sold its bonds at a significant loss, causing distress among both its customers and investors. Following SVB's announcement of its $1.75 billion capital raising on March 6, 2023, concerns emerged that the bank was experiencing a capital shortage. As news of this spread, customers began to withdraw their funds in waves, leading to a bank run. Subsequently, the bank's stock plunged by 60% on March 7th. The following day, on March 8th, California regulators intervened and placed SVB under the control of the FDIC, the Federal Deposit Insurance Corporation. Unlike personal banking, SVB's clients typically held much larger account balances. As such, the pace of withdrawals during the bank run was swift, resulting in a snowball effect. Most depositors had balances exceeding the $250,000 FDIC limit. Rather than using alternative accounts like money markets for expenses, many startups maintained significant balances in their primary Silicon Valley bank accounts. Their working capital was heavily dependent on SVB, and they needed prompt access to their deposits for payroll and other expenses. As you can imagine, when the collapse was announced, it did not go down well with these companies or their investors. In fact, SVB shareholders and investors experienced significant losses because their investments were not protected by the FDIC, unlike the deposits of customers. Major technology firms such as Etsy, Roblox, Rocket Labs and Roku had significant amounts of cash deposited in SVB. Besides, FDIC insurance only covers up to $250,000 per account. This is not sufficient for most company accounts, as they often spend millions of dollars each month. US authorities also took over Signature Bank of New York on March 12, 2023 due to concerns about its clients' involvement in the crypto industry, making it the second institution to be taken over in the space of 3 days. Signature Bank was particularly vulnerable to a bank run, similar to SVB, because of its exposure to the crypto sector. The following Monday, shares of many banks dropped, as investors sold amidst rising concerns about the financial market. That same day, US President Joe Biden pledged to take all necessary steps to ensure the safety of the US banking system, following the failures of both SVB and Signature Bank. To safeguard insured depositors, the FDIC established the Deposit Insurance National Bank of Santa Clara. When SVB was shut down, the FDIC promptly moved all insured deposits to said bank. According to the FDIC, Silicon Valley Bank had approximately $209 billion in total assets and about $175.4 billion in total deposits. At the time of closing, the amount of deposits in excess of the insurance limits was undetermined. Customers with accounts in excess of $250,000 were advised to contact an FDIC hotline. Importantly, Silicon Valley Bank will not receive a government bailout, and it will remain collapsed, with its remaining assets distributed among its creditors. The possibility of reviving the bank lies in its potential acquisition by another bank, as is likely to happen with the UK portion of SVB after HSBC announced plans to purchase it. Meanwhile, reports from US media suggest that the collapse of Silicon Valley Bank is currently under investigation by the Department of Justice and the Securities and Exchange Commission. The focus of the investigation centers on executives allegedly selling shares in the weeks leading up to the bank's failure, as well as possible instances of fraud. Although the SEC has not yet commented on the matter, Chairman Gary Gensler stated that his agency will be looking into any misconduct that could potentially threaten investors, capital formation, or the markets in general. He added that the SEC will investigate and take enforcement actions against any violations of federal securities laws without singling out any individual or entity. As for how SVB's collapse could affect the financial market in future, the volatility of bank stocks could potentially lead the Federal Reserve to exercise greater caution when considering rate hikes. While larger banks are typically well diversified and have effective hedging strategies, smaller regional banks may be more vulnerable to market tightening, particularly if they are closely linked to cash-strapped industries like tech startups. That said, the initial panic has begun to subside, mainly thanks to the US government's announcement of a guarantee on bank customer deposits. Stocks and financial futures increased after the guarantee by 1% to 2%. However, there are larger issues at play, such as the potential impact of rising interest rates and the degree to which other banks may be overinvested in falling bond prices. To address these concerns, the Federal Reserve has implemented a new program called the Bank Term Funding Program, which provides loans to banks and credit unions to meet customer demands for US Treasury and mortgage-backed securities, thereby preventing banks from selling long-term government securities at a loss during times of stress. The collapse of SVB and Signature Bank has clearly caught the attention of the International Monetary Fund, which has been closely monitoring the situation. However, Deputy Managing Director Geeta Gopinath has stated that, at least for now, the crisis does not appear to be causing a global shock. In a Twitter post, Gopinath noted that the SVB crisis has not yet exhibited the characteristics of a global risk-off shock, and that emerging market currencies have been only minimally impacted. As for the US banking system, Moody's Investors Service, which is one of the 3 major credit rating agencies, has issued a warning by changing its rating from stable to negative. While the Department of the Treasury, Federal Reserve and FDIC have announced that all depositors will be made whole, Moody's pointed out that the rapid and significant decline in depositor and investor confidence leading up to the announcement highlights the huge risks facing the industry. The collapse of Silicon Valley Bank is an all too familiar tale that highlights the importance of sound financial management during both lucrative and not so lucrative times. SVB's failure in strategy has caused widespread concern, and while the US government has stepped in to limit the damage, the effects of yet another bank collapse have created a ripple effect that could at best prevent another such disaster from happening, and at worst lead to a major setback in the evolution of technology.